Good morning, everyone, and welcome to another webinar here by FCI Markets. My name is Justin Paolini, Head of Trader Development here at FCI Markets, and we are starting right on time today. So welcome. Thank you for taking time out of your day to join us. Today, we're going to be talking about tilting the odds in your favor. Before we start, let's just go through the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your initial deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. And with that said and done, all right. I think most of you already know me. I've been on the retail side of the FX markets for the longest time, and fortunately I survived. I learned a few things in the process, and I eventually graduated onto the institutional side, providing analysis to institutional clients through 3C analysis, and now acting as head of trader development here at FCI Markets. So basically, I've made every mistake in the book twice, and I've also written a book on all my mistakes. It's called Building a Trader. You can find it on Amazon. And here at FCI Markets, I'm trying to help you simplify your trading habits and also help you achieve the kind of consistency that it takes to join our team and to receive funding to become a professional trader. Because we know that one of the most difficult things for traders generally, for aspiring traders, is capitalization. And that's why I always stress that it's not really important how much money you make as you go about your trading on your own accounts, as you grow your track records. What is important is the percentage return, and you're limiting your risk, because if you can deliver good risk-adjusted performance over time, and you can prove that to us by trading on one of our accounts for 3 months at least, then we can start funding you and rewarding your discipline and your consistency. And through this funding program, you can receive an allocation of up to £1 million. And excuse me for tooting our own horn, but I think that's a lot of money for anyone by any standard. And all it takes to achieve this is just consistency and discipline with your trading process. And that goes back to what we're doing today and going about and the other webinars, transferring knowledge and best practices to you so that you can, find your way amongst this, this job that we call trading. A couple of reminders here. If you need any guidance, we have a free course that I put together. I've condensed my trading experience into 12 concise lessons. You can go and get your free course at fci-markets.co.uk/promotions/free course, or just go onto our site and you can find it there. Instead, if you want to take things to another level, then you can get serious about things coming to our academy. And in there, it's a month-long program. Okay, so it's 4 weeks at least, with interactive sessions, interactive webinars every week, and on-demand video recorded sessions. And there's a constant interaction with me in there. So this is of course more expensive than the free course, but for people that are really serious and that want to accelerate their trading conditions and get up the learning curve quickly, this is a solution that we propose. And also, Academy graduates have a priority route towards funding opportunities. So that's the additional benefit. And now on to today's session, tilting the odds in your favor. And since today is ECB day, we're going to talk a little bit about the ECB. And since everybody's talking about it, we're also going to cover something about the US elections. And let's get on with the show. before I start here, can you just let me know that you can all hear me? Can somebody write me whether the audio and the video is good? Just want to check that. Yes. All right. That's been confirmed. Excellent. Excellent. Thank you. Okay. So Bollinger Band setups here. Last time that we had a webinar, we talked about some simple setups on the daily scale, okay, that were so simple, but at the same time, they allow you to position yourself opposite retail traders. Okay, so the key functionality of these setups is that they invert the bad habits the retail traders bring to the table. Okay, and that's it's so simple as a principle. You know, it's much easier to find a losing trader than it is to find a winning trader, because broker statistics are very clear. Over 70% of traders lose on a consistent basis. So it's really easy to find a losing trader. So what do? Well, we find out what a losing trader is doing, we flip it on its head, and come out with a profitable system. That's what the Bollinger Squeeze and the momentum corridor, which we talked about in the previous webinar, are useful for. So those are the two setups we're going to focus on today, because they have the strongest correlation, the strongest inverse correlation with typical retail trader behavior. So just a refresher on trading the squeeze. The squeeze is nothing more than a volatility contraction measured, in this case, via a standard 20-period Bollinger Band, and we're measuring it with the Bollinger Band bandwidth standard indicator. All this does is measures the distance between the top and the bottom Bollinger, okay? So it measures the volatility, since these lines are built based on standard deviation, okay? And they're plotted 2 standard deviations away from the mean line here, from the 20 simple moving average in this case. And there are many variations of the bandwidth. This is the simplest one. This is the original one that Bollinger himself created back in the 1980s. And it just shows you that when volatility, which is cyclical, which is, volatility is easier to predict than price. When volatility declines to a certain amount, and I've plotted 200 pips here as a decent gauge for the euro dollar. Each currency pair will be a little bit different. If you have relative measures of volatility, then it makes everything easier to understand. But in this case, since this is a very common indicator that anybody can find for MT5, I just decided to use this, and I plotted 200 pips as our volatility cutoff. So we're in a contraction, and you can see it visually on the bands as they narrow, right? So it's extremely simple. And then all you do is you have a close above the bands. In this case, sorry, it was here, the first close above the bands, and that's breaking out into a bull market type. So it's extremely simple. And the same case is here, close below the bands that were really narrow in a volatility contraction, and we're into a bear market type. And there was another example back here. What I had highlighted last time is that these the breakouts into a bear market type and into a bull market types here and here are absolutely opposite what most retail traders are doing. Retail traders were sort of undecided here on what to do, whether to flip long or short, but once the market broke out into a bull market, they knew what they had to do. They faded it, and they positioned themselves contrary to that breakout. And again here, after leveling off some of their short exposure, retail traders accelerated in shorting the euro as the market was breaking out into a bull market again. Okay, so that's why the squeeze is sort of smart. It's witty, because it's doing exactly the opposite of what common retail traders are doing. The second setup, just the other refresher here, is the momentum corridor. Now we're not concerned about volatility in this case. We're concerned about where price is within a certain from a volatility perspective. We want price to be within the first and the second standard deviation corridor. Okay, and in this case for bull market, okay, bull market, bull market, bull market, and in this case bear market, and then up here bull market again. Okay, this is called the momentum corridor because the market is usually pushing very strongly when this happens. So it's not for pullback trading. It's not for outright trend trading. It's for momentum trading, which is when you can use the principle of immediate gratification. The market should move aggressively in your favor, and if it doesn't, you know that something is wrong, and your trade management can adjust that to suit the occasion. So even this setup here is strongly is inversely correlated. There's a strong inverse correlation with retail trader behavior. If you remember where the corridors were, okay, here there is a little bit of negative corridor down here, positive corridor up here, negative corridor here, a bit of negative corridor here, positive corridor up here. So you see that as the market pushes, okay, as it crawls up the band, retail traders are shorting. Same thing up here, retail traders are shorting, and then as the market flips down into the negative corridor, okay, in the bearish momentum corridor, retail traders are flipping to a long stance. So, the principle is sound. The setup is really simple, and now we're going to understand how we can actually, maximize these opportunities. Because, so let me just go back one slide. Because I know a lot of traders, especially traders trading around a day job, would love to have some kind of set and forget system where I say, okay, it's closed in the in the long momentum corridor. Let's just enter there with the stop loss down below the day's low and hold it forevermore. Now, unfortunately, the markets don't allow us to act in such a naive manner. In order to maximize the opportunity that you have, it usually pays to have good trade management, number one, but it also pays to try and stack the odds more firmly in your favor by using a time frame combination. That doesn't mean it's more complex. Okay, we're not looking for complexity. We're just looking for time frame tools that can help us have a smaller stop loss compared to the same kind of daily reward if the trade progresses. Okay, because odds, when we talk about odds, we're talking about odds from the betting world. Okay, the odds are the reward that you achieve. Okay, and we in trading we call it risk to reward. And if your average win is only, for example, 1R or 1.5R, or even less than that, because I've seen a lot of traders that adopt negative skew strategies where they have a ton of small wins, and the wins are like 0.5R, 0.7R. Okay, that is inefficient in the long term, and even in the short term, I should say, because your wins do not make up for the amount you are risking on that trade. And this is really the key conversation we need to have about odds. Okay, now I can go back down to that slide. If your wins are smaller than your losses on average, you will be under a ton of pressure to win. Okay, so each trade, and emotionally, that is, that's tremendous. It is hard to trade well, to remain objective, and to run your profits, especially if you are under pressure to win. You will always be, prone to taking profits quickly, to bailing from positions that aren't really doing much, and you'll be fearful of actually entering into the market. Okay, there's a ton of pressure there. Believe me, I've been there. Previously, I've had to operate a negative skew strategy, okay, with a very high win rate, but where the wins were much smaller than the losses. And the result, many years ago in 2016, there was there was a time when I faced a large drawdown, and there was just no way to get out of the drawdown. Okay, I had cut position sizes. I'd been selective with the entries, but it's just the wins were about a seventh. Okay, so it took seven wins to make up for one loss on average. Yeah, the wins were so small compared to the losses that the math was just impossible. And of course, the pressure to win drives you insane. So don't make that same mistake. Okay, don't think that trading well is just about making money. I was recently pitched by a group of people that that set up one of those 45-degree equity curve kind of systems that usually martingale their way out of trouble, that you see on MyFX book, that kind of thing there. And they all use the same kind of principle. There is no consideration for risk reward on a trade by trade basis. Okay, but this is the key, especially when you're growing your equity curve in your own account, when you're trading your own money. Okay, and it's the same thing when you're trading other people's money, but when you're trading your own money, it's tougher. You need to have respect for the money that you're throwing at the market, because just like any professional gambler will tell you, you need to annualize your habits. So if you are throwing money at subpar bets, or bets that you think might work, they might deliver 1R, they might deliver a little bit of cash, and you're just throwing money at it because you say, yeah, I might win a little bit, a bird in the hand is better than two in the bush. That doesn't work in the long term. Okay, you need to think beforehand. If I take this kind of trade time over time, time and time again, after 100 trades, where will I be sitting? How will I be feeling? What are the odds of me risking, I don't know, 50 euros, 100 euros, whatever your budget is, right? Risking that 0.25, 0.5%, maximum 1% on each trade, whatever that is in monetary terms. You can visually put that on your desk. Put a check on your desk for 100 euros, or put 100 euro on your desk right in front of you, and you visually see that you're going to throw that at the market, and you're going to risk that. Okay, you might never see it again. So when you know that, with that mindset, what kind of trade are you going to take? Are you going to take a trade that might give you 50 euros, that might give you 25 euros if you're risking 100 euros to take the trade? Or are you going to wait and be patient because, you obviously, it took you a few hours of work to make those 100 euros. So, why risk it on a subpar trade? Why not risk it on a trade that can deliver 200 euros or 300 euros or more? Yesterday, I had a student that delivered an 8-hour trade on Canada yen. You can actually go and see Canada yen, and you can see the enormous drop that it had. And it's an 8-hour trade. So if you risk 100 euros, you made 800. These are the kind of trades that you need to take, and that you need to understand how to structure, because you don't need to care about the losses, because your wins will take care of the losses if you can run your profits like that. And if you can learn to only risk your capital on the kinds of trades that look like they can deliver that. Okay, there is sort of an inverse relationship between win rate and the return in our terms. So what we need to try and do is remain around the 50% mark on the win rate, but at the same time get 2, 3, 4R on our trades on average. Some of them are going to be they're going to be huge trades, 10R or something, and some of them are going to be scratched, some of them are going to be losses. But on average, if your average win is around 3R with a 50% win rate, you're laughing. Your Sharpe ratio is going to be tremendous. So we need to learn how to do that. Okay, and that takes us to today's session and the principles that we're going to explain today. Now I know that I'm putting a lot of wood on the fire. So if there are any questions in the meantime, or if anything isn't clear, if I'm going too fast, please do let me know, because this is kind of important. So how to stack the odds more firmly in your favor? How to get those multiple R possibilities? The principle is you need to use a smaller stop loss. So if you have a daily setup, don't use a daily stop loss, but use a smaller time frame with a setup, of course, that gives you, an entry, setup, and trigger that allows you to position your stop loss closer. That's the simple logic. Because if you go into the math of the expectancy equation, what you'll notice is that with a tighter stop loss, you can already affect 3 out of the 4 variables of that equation. Okay, now your win percentage will be slightly lower if you're using a tighter stop loss, but the loss percentage will be slightly larger, but your losses will be smaller. Okay, even though you lose a bit more frequently, losses will be smaller. Your wins will be much larger in comparison. Okay, so your average win to average loss ratio will be much more favorable. Okay, and that's the key. The average win to average loss ratio is really what we're talking about here. And using the tighter stop loss is what we need to do this. So here's the structure of today's examples. Okay, we're going to use a daily setup, and then we're going to use either a 4-hour or 1-hour execution and management. Okay, so the objective is evidently multi-day in nature. Okay, because working off of the 4-hour or the 1-hour, it's entirely possible, to close your trade intraday, but it doesn't really make sense unless your trade management, dictates that you need to exit. Okay, unless the market really does something weird, because you are starting from a daily setup. So you're trying to run your trades using these smaller time frames, and I think this is ideal for people trading around a day job, or for people that aren't that aggressive in nature, and they don't want to be taking 5-6 trades a day, or with that really high frequency. So that's what we're going to look at. It was, I have to say, the markets up until a couple of days ago, the markets have been choppy and indecisive and ugly for the past 2 weeks. So it was tough to find these examples, but these 2 examples that we're going to see today for the momentum corridor in particular, they were Aussie New Zealand had been highlighted in our weekly reports in the past couple of weeks, because obviously it started trending. It was breaking out of its recent range. There was a decent sentiment driver behind it, with the RBA rate cut expectations, and also Kiwi strength. Kiwi has been very resilient recently, so it was also one of our trending candidates. And so the 2 things matched up, and I was able to bring this example to you. The other one is New Zealand dollar, which we'll see later. And then the squeeze, I think I have brought the euro as an example of the squeeze. So I'm just going to have a sip of water, and then we'll go into the momentum corridor example. All right. So the principle of the momentum corridor. The market closes inside the momentum corridor. Okay, in this case, it's the bearish corridor, so we're only looking for shorts. Okay, so in no case throughout all of this time down here, okay, should you be looking long. And I want to highlight this because one of the bad habits that I see with a lot of aspiring traders is that once you give them a structure and they start to take a couple of trades with the structure, and the trades are winning trades, they then start to feel omnipotent and they start looking for opportunity on smaller time frames against the trend, etc. So just go off track. So the principle with these daily setups and exploiting the daily setups on the smaller time frames is that you want to be patient. You want to follow, one direction, one bias, one setup, and you want to become a specialist of that one direction, one bias, one setup. Don't go system hopping. Don't go looking around for other trades. If you want a higher trade frequency, then you could even potentially use the same daily situation and drop down even more into the intraday time frame spectrum. But then again, if you have a day job, that's not really practical because you need to monitor the markets more closely. So first things first, discipline with the approach. This was the first day that the momentum corridor trades could be considered, because the day prior, okay, we closed inside the corridor, and so we start to look for our short opportunities. The time frame we're going to be using for Aussie New Zealand is the 4-hour chart. Why the 4-hour chart? Because it's a slow mover. The volatility of Aussie New Zealand is ridiculously low, so it doesn't really make sense to drop onto a 1-hour chart or even into the intraday scale. Is just that's ridiculous because it moves very slowly. Okay, I mean, 100 pip move on Aussie New Zealand is, look, from here all the way down to here. I mean, that's a lot of space. This leg here is about 100 pips, and it takes a few days to do that on Aussie New Zealand. So patience is required. Now, what I've highlighted here is one of the other concepts we're using to help trigger our trades in line with the momentum. Okay, so on the daily chart, we know that we're down in the momentum corridor. Great. 4-hour chart, what are we looking for? One of the things that I like to look for is either a fair value area like this. Okay, so the fair value area is basically a little consolidation patch, and they become more evident if you squeeze your chart. You notice that my chart's always squeezed. Okay, and I actually squeeze my charts more than this sometimes, because it helps you to highlight where price is actually consolidated for any length of time and is then departed with any degree of of momentum, because these are momentum setups, so we're looking for momentum. The other kind of price point that I like to look at for these setups is a swing point or a pivot, depending on what you call them. These are areas on the chart that the market departs from. So they the typical V-shaped reversal. Down here was one, and up here was another, and they are down here we have another, and these are levels that have hosted a certain amount of orders in the recent past, and price might react in the same in the same area. So the idea is that if price breaks through that area, we'd like to have a retest to that area and look for our setup there. So on the way down, but the thing is you have to update these setups. Now, a lot of people that use this kind of principle, they call it like demand supply, and they look for pip perfect entries in these areas. I don't subscribe to that, and most of the traders that have come to me using that kind of trading solution never really got anywhere, because they end up placing limit orders really far away from price, and they expect the market to do something or another. I don't subscribe to that, especially not the pip perfect entry. And the other thing is that you need to take into consideration the current momentum, current direction of price. So these levels, as we'll see in today's examples, these levels need to be updated as the market produces them, and not waiting for levels that haven't been hit for like a month or weeks, expecting the market to bounce from there. Okay, it's the mindset of those demand supply traders is dangerous in my experience helping traders with that. So here's how to use it properly. For example, we have a consolidation area on the 4-hour chart. Okay, so if we pull back to that area after this departure, it's a good location to look for a trade in line with the current momentum. Okay, this is what happened afterwards. So the market did pull back to that area. Okay, now it doesn't matter where in the area it pulls back to. Okay, we're not looking for a pip perfect entry. What we're looking for is just to pull back to the area, and then we're not looking to pick tops or bottoms. We're looking for the market to resume the downtrend and to form a high. That's all we're looking for. So, you know, these bars moving up form a low, and then after it prints this bar here, okay, very tight range bar, which is good for us because the market is stalling. Then the next bar is, or the next candle rather, is a negative candle exposing this high as a swing point. So now the market has formed a lower high in line with its trend. This is the most basic entry you can use in a trend. Okay, and that's it. That's as sexy as it gets. The thing goes up and it prints a high. And when the high is confirmed, okay, on the close of this next candle, that's already a signal you can enter the market. Because a high has been confirmed, it's a lower high, we're still in the trend, and it's an excuse to get in the market. It's as simple as that. Okay, you can backtest this, you can study it when the market is trending, but I guarantee it's simple and it's as good as many other triggers to get in the market. Because the market has formed a high and it's coming back down. You're not picking tops, so you're avoiding one of the other issues that many traders bring to the table, which is picking tops and bottoms, fading contrary momentum. Now we're not doing that. We're waiting till the price forms a lower high in line with the trend. Okay, and now let's go forward a little bit. Now, when price came back down, okay, as price came back down, when it came back down to the previous low and printed a fresh, a marginally fresher lower low, obviously it exposed this point as a supply area. Okay, but the market may not pull back to that. And as the market prints and goes about its business, it can also print lower supply areas as well. Now that's exactly what happened here. The market made a very small pullback here, okay? And then it pushed even lower. And this exposed a supply area, okay? Because there was just a decent departure from this rejection area. So that's what I mean by updating your areas as the market goes upon its business. Okay, and this area too, okay, the area that the market created after it declined again, this area too is an area of supply. So you need to update your your areas in order to always have the most ideal location possible for your trades. Okay, so once again, the market formed this area on its way down, and then finally it pulled back to that area. Notice that I'm not interested in taking trades unless the market pulls back to the location I have identified. Okay, no location, no ideal location, no trade. So here we're going to use the same logic. The market is pulling back in the area. I'm looking for it to form a lower high. Okay, and that's what it does here. Okay, so we have a spinning top formation. The next candle is a negative close, okay, with a bit of downside rejection, but it's got a lower high, okay, and it posted a marginally lower low. I would have liked to see a stronger negative close on this candle, okay, and that's why if I had executed this trade personally, I would have executed it on this third candle here, okay, showing a lot of topside rejection and a much lower close. Okay, I would have executed on the close of this candle. But the concept here is always the same. You're just waiting for the market to form a lower high. When the high is in, you've got confirmation and you can enter the trade. The idea is to not fade. And the funny story is that now in the next, actually I was trading here This is actually where I did actually trigger a trade, and the only thing is that I screwed up the management because the thing just wasn't moving. And after this rejection here, I actually scratched the trade after the market rejected the lows, and because I didn't like this. So instead of just holding and understanding that Aussie New Zealand is a slow mover, I actually cut my trade here, basically break even. Only the market continued to move lower after that. So it happens to the best of us. Even the best of us screw up. I'm not one of the best, so I screw up even more often. But I'm telling you that because I was doing this myself, and so this is a trade that I was invested in. I had skin in the game, so I'm telling you from personal experience what was going on. But yeah, if you're waiting on a multi-day, and the other thing is that my trading is intraday in nature mostly, so holding for multi-day is something that becomes a bit more difficult to me. But anyway, the situation was appropriate. I triggered the trade just as I'm illustrating to you right now, and the market rejected lower prices. I decided to cut the trade. However, the market still continued without ever really testing your stop loss, which would have been above here. Okay, so you notice these are really tight stop losses. Stop losses above these swing highs. It's a typical location. Don't put it 1 pip above the high. Maybe put it a buffer. For Aussie New Zealand, it might be 5 pips. For sterling yen, it might be 20 pips. It depends on the volatility of the pair. But the idea is that you get a really tight stop loss above the swing high, and your risk reward, if the market continues, is extremely favorable. Okay, so these are the actual setups. These are the actual ideas that were worth taking on this Aussie New Zealand. Okay, and the market, by the way, formed another supply area, and I triggered this trade as well. Okay, and the market pulled back. It posted the negative close inside candle, showing a bit of consolidation after touching the zone, and then the market broke through the low of that candle, which was my trigger. And the thing is, it then chopped around. So once again, I decided to cut the trade because it wasn't doing anything, and the market continued on its merry way anyway. And so I didn't get anything out of these potential opportunities just because of my trade management, which is more focused on the intraday scale. But anybody holding for a multi-day run on Aussie New Zealand, which is what Aussie New Zealand is best suited for, would have had excellent risk-reward opportunities in a trade that is still going. I think it only pulled back the other day, but it's still going. I mean, and it's so simple. The principles I'm showing you here are so simple, and I encourage you to try them. So what have we actually done here? We've taken a daily setup. Okay, we're in the momentum corridor, and what are we doing? We're just identifying good locations, okay, areas that the market has reacted from in the recent past. And then in that area, we're looking for the market to post a lower high. Now notice that on this 4-hour chart, the market remained within its trend on the 4-hour chart as well. This is an excellent confirmation of this principle, that the principle of immediate gratification and the multi-time frame confirmation. The market is even on the 4-hour chart remains contained within its 20 moving average, so it is sloping down within the downtrend, and the market is pulling back to the average, not going into a sideways market type, but remaining within the downwards trending market type, which is excellent. And it's an additional, it's a good kicker, that gives you additional confirmation and confidence when taking your entries. So let's go to the other example. New Zealand dollar. New Zealand dollar was very similar in nature. Okay, it was chopping around for a couple of weeks, really ugly market, and then it started to push higher. So after this close in the top part of the momentum corridor, we can start looking for setups. Now, on Aussie New Zealand, which is usually a range-bound cross, I suggested sticking to the 4-hour chart for this kind of objective. New Zealand dollar has a slightly higher volatility because New Zealand dollar tends to trend more than Aussie New Zealand because the economies are more distant. So in this case, we're going to use a 1-hour time frame to look for our areas, look for our locations, and for triggering our trades. So this is the only trade that there was on New Zealand dollar in the recent, in the past few days. So when the market closed, okay, on this day here, it closed inside the momentum corridor. The most recent hourly, location or area that had acted as support and had pushed the price higher was here. Okay, you notice the market pushed up, so there's another area down here. But remember, we have to track the most recent areas, because if the market is strong, if the market is going to show decent momentum, it shouldn't really pull back that far. Okay, it should use the most recent support area in line with its trend. And this was the area, because the market from here pushed into fresh highs, and it showed a fairly evident momentum boost. And also, it's showing support, basically. Support and departure are what you're looking for. And the market pulls back. The market pulls back to the area. And when it starts to transact the area, okay, you're looking for that swing low confirmation. And what we have here is an actual outside candle. This is a bullish outside candle. This is during the Asia time zone, just at the beginning of London. So it's also the right time to trigger the trade. And what do we do here? So why is this confirming a swing low? Because number one, it is the lowest low of the past few candles, and it broke through, the highs of the recent candles. And this degree of momentum, with the candle pattern itself, gives me personally enough confidence to try the trade. I know that we don't have the third candle here, so we don't have the lower high coming in, just to confirm this is a swing low. But when you have candle action like this, an engulfing or an outside bar, you don't really need, the other confirmation. You can actually take the trade directly from the close of the candle, and that's exactly the kind of trigger that was available here. So, instead of placing your trade and instead of placing your stop below, the low of the day that closed inside the corridor, okay, because that's the daily way of doing this trade. The day closes inside the corridor, great. Enter at market, stop below the day's low. That there is a 50 pip stop, maybe a bit more, but around a 50 pip stop. Whereas here, you're getting into the same trade with a 15 pip stop, maybe 20. So it only takes 20 pips to get to 1R. Okay, and if you take into consideration the day's true range, or the ATR, you have the potential to make more than 1R intraday already. But since our objective is multi-day in nature, the deal is even sweeter, because the thing can continue for multiple ATRs, if momentum is strong enough and it just continues on. And that's what we're looking to do. We are looking to stack the odds in our favor, get these tighter entries, tighter stop losses with an entry setup, of course. So entry setup on a smaller time frame within the daily context, with a tight stop and decent space for the market to travel in our favor if it wants to do so. Now that's the principle, and it did work. It worked intraday here. If you wanted to do this intraday as well, it worked intraday, and the market, and this formed a demand zone. Actually, this departure here formed support and demand. So when the market came back down, you can also look at this as a second opportunity to get into the same trade. Okay, and the market did react, because if you are following the momentum corridor on the daily scale, especially if you have some kind of momentum, some kind of sentiment kicker behind you, so a reason for the markets to be trending, the consistency factor is very high. Okay, the odds really are stacked in your favor. Now we're going to look at the squeeze. I'm just going to have another sip of water so I don't lose my voice, and then we'll go on to the squeeze. All right, squeeze. So volatility contraction, and the market breaks into a bear market type. Really simple. There's no question about this. Bear market type. We're going to use the 1 hour chart on Eurodollar as well, because the volatility here is even higher than it was on the Kiwi. So what are we doing here? Same principle. Okay, we are looking for pullbacks to supply areas in this case, because we're in a downtrend. So intraday, here we go. The market, this was the day that closed below the bottom Bollinger, breaking out into a bear market type. So the next day, we're looking for those value areas, right, for price to pull back to. And there was one here. This is a potential area of supply, but the market didn't pull back to it, and instead it bolted lower intraday, forming, exposing this area as a decent value area, decent supply area. So that's what we're looking for. The market to pull back and make a lower high on the hourly scale. And it did, because it went up and then it posted the lower candle here, exposing this as a high. So on the break of that candle low, we are in the market with a stop loss above the top right here. So once again, it's a 25 pip stop approximately. And already intraday, you get about a 1.9 to 2 hour trade, okay, intraday. But we're looking to hold this for a multi-day trade, if possible. And the thing does continue. So already down here, you're probably down to 3.2 hour. The market at this point has exposed this area as a fair value consolidation breakout area. So if we pull back to this area and form a high, we can also pyramid into our trade. We can add to it. And that's what happens. The market pulls back, forms a high, because here we have the inside candle, and the break of the inside candle exposes this as a high. That's confirmed. So we're in the market once again with an even tighter stop, and the market continues on its merry way, and it continues to print lower highs all the way down, remaining within its trend. And now you've got two positions in the market, and you've made potentially, I think it's about 5 or 6 hour on the first trade, and you've got 3-4 hour on the second one, both in the market. Okay, and it is so the odds are phenomenal when you're able to do this. When the market, and so you don't have to worry. The principle of this is that you don't have to worry whether the next trade is going to be a winner or a loser, because when the market does act as expected, you're making multiple times what you risked. So even if you lose a few times, you know that it takes maybe one win to make back a handful of losses. Now that is a good situation to be in, because you don't have to worry about wins and losses. You don't have to worry about whether the next trade is going to be a win or loss. Now, and that's actually what happened over here. The market was still in the momentum corridor. This zone here is a supply zone, so it's a decent area to look for potential swing highs when the market pulls back. And the market did pull back, and it printed a high. Okay, this was exposed as a high as the market broke through the low. However, this trade didn't work, and this trade was eventually stopped out. Now, whether you cut it, before it actually gets stopped out, when it doesn't react, when it prints a high or low over here, and you actually cut the trade, it doesn't matter, because you know that when your trades do work, you have multiple R runs. If the trade doesn't work, the worst case scenario is that you lose 1 R. End of story. You know, let the math take care of itself. The other more recent example of the squeeze was a long scenario. Let me go back to the daily chart so you see that. And that's up here, okay, because we were in the volatility contraction and the market broke into a bull market type. But we didn't have any triggers here because the market, this is the day the market closed into the bull market type. And we had one kind of value area here, resistance formed turned to support. But the trade, the market hit the area during the Asia time zone, which is not ideal for the euro. Okay, if you're going to trade the euro, you trade it and you look for setups during the European morning or into the New York morning, but that's about it. And by that time, the market was not reacting well. There were no setups. The market didn't print a swing low at that area into Europe, and instead it fell lower. And the market fell lower, contrary to momentum, and the 1 hour chart is no longer in the same kind of market type that our daily chart is in. And so in this case, there's no trade. There has been no trade on the euro throughout all of this process here, because the market needs to actually move into a it has to be in the same kind of upswing that the daily market type is in, so that you have the mirror behavior or the self-similarity, if you want to call it that. I inserted this chart here to show you what happens when things work, because I showed you some borderline cases. Okay, we actually went through some difficult cases today for both the momentum corridor on Aussie, New Zealand, on Kiwi, and on the euro, because the markets have been rather choppy recently. But I wanted to show you what happens when things do work. This was a squeeze that happened back at the beginning of July, as the market broke out into a trending market type, into a bull market type on the euro. So you can go back and check the 7th of July and the 8th of July. When it broke out, the most recent value area was down here. Okay, so the market was unfortunately on the hourly chart trending against that when it hit that value area. But not to worry, the market started trending again, exposed another value area shortly thereafter, and then it pulled back, almost hit it, and it prints that higher low. Okay, and this is why I don't buy into pip perfect entries. If the market gets bid ahead of your value area, that's a sign of strength. So it forms the setup close enough to your value area, and that's fine. Okay, you're in the right direction. The market type is on the hourly chart is still heading upwards as it is on the daily. So you trigger that trade as the low is formed on the close of this candle, and away you go. The same thing happens multiple times. Value area is exposed, but the market doesn't get to it. It stops at a value area that is formed further up, and it prints typical herd behavior candle here, breaks through it, exposing the low, and you're in the market, etc., etc., etc. And the market just continues to go and go and go for days on end. So if you're able to get in these trades with a tight stop near the beginning of the move, okay, and you don't have to use the entry I'm showing you today necessarily. You can use your own entry, as long as you are obeying the self-similarity concept. So the hourly chart mirroring the behavior on the daily chart, with a trending market type, you're doing the right things. And when you do have a strong trend, you don't have to do much. You can just sit and let it mature. And I wanted to show you this because this is the kind of situation that you really want to get inserted into. It doesn't happen often. It happens a couple of times per quarter, but these are the situations where you just you need to milk them for as much as they'll give you. Now here are some pointers. The first thing to use this process, this top-down process properly, is to select your instruments. select them properly. Select the best trending instruments. Or if you are looking for multi-day runs only, you can stick to the instruments that have slightly lower volatility. The Aussie New Zealand, 4-hour charts, or Euro Sterling 4-hour charts. Instead, if you want, if you have more time and you want to get immediate gratification, you can stick to the higher volatility pairs. So you look for opportunities in Sterling New Zealand, Aussie, in Sterling Aussie, Euro Aussie, Euro CAD, Sterling Yen, the currency pairs that really move. So select your instruments based on your own appetite and your own objectives. Wait for the daily setups. Okay, and then they're simple to spot. And then, you wait for your hourly or 4-hour zones to appear, or for your hourly or 4-hour setups if you use different setups, which is fine. And then use that same setup time frame, 1 hour or 4-hour, for the execution and management. And try and roll your trades over for days on end as long as the market is performing. Okay, so you don't need to trade every day. Don't think, don't wake up in the morning thinking that you need to look for something. You absolutely need to do something. Actually, with these daily setups, don't happen that often. So, you need to understand that the trade-off to trading around a day job and to trading these, these multi-day situations is that your trade frequency will be slightly lower. Then you want to pick your spots wisely, okay? Because each trade you take, like we were saying before, you're risking your hard-earned money, so risk it wisely. Avoid unforced errors, okay? So don't trade ahead of important news like the ECB decision today or the US elections, etc. Don't trade in choppy markets. Okay, the markets have to be performing for your, for your game plan. Don't feel compelled to look for trades. Okay, let the trades come to you. Okay, and don't follow other people's tips. And that actually goes for the stuff that we're looking at today. You don't believe me at face value. Take these pointers and test them out for yourself and see how they fit you. Because at the end of the day, each one of us will see the market in a slightly different manner. Even if we're all using the same kind of setups, same kind of instruments, we will all see things slightly differently. So, cater to your own views and to what makes sense to you. Then demo trade before going live. Okay, don't take the stuff, apply it to a live account immediately. You need to have statistics that you have accumulated over the course of 3 months at least on a demo account before you can start risking money on a live account. Your demo stats, there has to be meritocracy here. Your demo stats need to show you that it's worth you risking real money. Okay, and patience is a virtue. You need to have patience. You need to have patience while you're demo trading. You need to have patience while you are waiting for your setups, and you need to have patience when you are, managing your trades and letting the market do its thing. Don't, and that's what screwed me up. For example, on Aussie New Zealand, I moved away from the multi-day management. I didn't like the way the thing was moving intraday, and that cost me, the missed profits basically. I didn't do any damage personally, but I guess emotionally it's difficult, knowing that you closed a trade, you didn't lose any money, but at the same time, the thing went in your favor and you're missing out. And for as much as, I'd like to believe I'm a balanced individual, I don't care about the money, I'm just trading the markets, it still bothers you a little bit. So patience is a virtue. Now, if you have any questions about all of this, just email me. You can email either FCI directly, and there's the email at the end of the presentation, or you can email me directly, justin.paolini@fci-markets.co.uk. Because I know that there's, we've put a lot of wood on the fire here today. Now, before we wrap up, let's just go through the ECB preview, since we have the ECB decision shortly, and we're going to look at the US election scenarios as well. I'm going to have a last sip of water, just one moment. All right, so ECB preview. What is the importance of doing these previews? The importance is knowing consensus, because just because there's a piece of news, just because there's an event happening, does not mean there's going to be a trade. The best trades happen when the market is surprised. In order to understand whether the market is surprised, you need to understand consensus. So that's what we're doing today. Currently, the ECB says that CPI inflation is showing exceptional uncertainty. GDP is expected to rebound in the third quarter. They don't see, at least up until the past meeting, they didn't see any necessity to change rates or quantitative easing, but they were monitoring foreign exchange conditions carefully. Now, the data, the situation with the coronavirus, the situation with PMIs, the situation with the US election uncertainty, no stimulus bill, all of this has changed the macro picture. So the consensus for today is bearish, or I should say dovish, because we're talking about central bank. And CPI, they're expected to say that it's going to be lower for longer. GDP may rebound in Q3, but it's expected to level off in Q4. So the forward outlook is a bit dim. The ECB is expected to talk about a PSPP extension, so a QE extension. And they're expected to say they're carefully monitoring FX, so no change there from last time. But there are significant changes in the wording to these other three components here. And the big one is, of course, extension of QE. Now, what could happen today? This is consensus. So if we get this today, there's not going to be much directional movement. When will we see directional movement? If the market is surprised. So the dovish case, okay, if the ECB comes out and is even more dovish and more bleak than expected, what should we look for? What do we need to see to justify that stance, right? They have to say that in terms of CPI, the ECB is highly concerned about that. The ECB needs to say the growth risks are tilted to the downside. So not talking about leveling off or neutrality, but they're actually tilted to the downside. They need to talk about QE expansion and rate cuts, negative rates, and you talk about negative rates, etc., etc. And they also have to say that the euro is weighing on inflation. So this is the most dovish scenario. And there can be variations on the theme, but basically, you're looking for dovish revisions to consensus. And the hawkish case would be the opposite. For the ECB to talk about balanced inflation risks, balanced growth risks, no change to the QE plans or to rates, and euro strength is irrelevant. Okay, now this is very unlikely. Okay, this hawkish case today in the current context with France, with Germany already locking down the economy, with Italy talking about locking it down in 15 days, Poland as well. It really is difficult for the ECB to sound hawkish today. But at the same time, the markets have priced in a significant amount of dovishness. So, the risk is that the risk, personally, and I might be wrong, but the risk here is that unless they talk about rate cuts and a large QE expansion, the markets may not do anything because the markets have already digested a significant amount of dovishness. Okay, so I will be looking for strong dovish wording, and unless we get that, the risk is that we actually have some kind of neutral choppy action or a short squeeze. Now let's go on to the US election preview. I've just summarized the scenarios for you because there are all sorts of people doing all sorts of webinars on the US election. Bottom line here is that most analysts expect a blue wave. Okay, most analysts expect Biden to win with a landslide, and they also expect the markets to accept that as a favorable scenario because of Biden's economic plans, stimulus, blah blah blah. That's what the markets are looking for. So obviously, if we don't get a blue wave, if we get a contested election, or if we get a divided government, or if we get a red wave, the markets and the analysts are going to be really surprised. Whatever move we get is going to be large, and I don't really buy into their analysis that a blue wave is going to be good for risk and a red wave would be bad for risk. I think what's going to be bad for risk is a divided government or a contested election. But I think that in either case, whoever wins is going to expand the balance sheet, is going to spend in any case, and Trump is also going to keep taxes lower for businesses. So in the long term, I think analysts are underestimating the benefits of another Trump presidency. But the important thing is that we know what consensus is. So consensus is for a blue wave, and they're attaching an 70 to 80% probability on that. That's a lot. The divided government, they're only placing around 20% probability on that. And the split government, as long as Biden wins, shouldn't be too bad for risk. It actually might be a slight positive. That's the way the analysts are talking right now. A red wave is not expected. Okay, there's a very low probability attached to this, and the analysts expect this to be negative for risk. And a contested election would be a big negative for risk because the uncertainty would drag on into the future. It would mean no passing stimulus bills. It would mean no clear decision making in Congress, just a mess. So this would be the worst, the worst scenario. And surprisingly enough, analysts are not pricing this in very much. Now, I think there's a high probability of a contested election. And again, I could be wrong, but from, I don't live in the US. I don't have a strong pulse for common sentiment for on the streets and what's going on. But I can't believe that either side is going to accept defeat. And that's I think that the markets are underestimating the probability of a contested election. But anyway, we'll see. To take us back to trading, whatever you do, keep things simple and remain consistent. And if you need guidance, of course, just get in touch. This is the usual reminders. Subscribe to our blog if you haven't already. We have the free course that I talked about previously. If you want some more tips and some different tricks for entering the market, there's our academy. And, of course, you can follow us on Twitter for immediate updates. And now I'll just open up the floor for questions for a few minutes because we've gone overtime here, and I know I've been yapping away for over an hour. So let's keep this short and sweet if you have any questions. Good question. Trade management. Okay, you noticed I didn't put trade management in this webinar because I didn't have time. Now, we've already gone through an hour here, and I've already done a separate webinar on trade management. You can find it on our YouTube channel, FCI Markets. It is under the playlist Trader Foundations. So if you go into the Trader Foundations playlist, you'll see I did an entire webinar on trade management. And I used intraday examples, but also hourly examples as well. The principles remain the same. You can just go and take those pointers and apply them to the examples here. You can also apply the same principles to a 4-hour. But I did an entire webinar on trade management, so just go and see that. All right, no other questions? All right, then I will let you get back to your day. Thank you again for coming. It's always a privilege to be able to be here and help you out with your trading. But again, please get in touch if you have any questions or concerns, because we are here to help. This is Justin Paolini for FCI Markets. Over and out.